Hey everyone, welcome back to Corporate Decoder, the place where we turn complicated corporate documents into something you can actually understand. Today we're diving into a report from the Federal Home Loan Bank of New York, or FHLBNY. Don't worry, it's not as boring as it sounds. Think of it like this: we're going to see how this bank borrows money and what that means for the rest of us. It is like peeking behind the curtain to see how the bank funds its operations. So what's this report about? It is called a Form 8K. Companies use these to tell investors about big news or important events that could affect their business. In this case, it is about how the FHLBNY is creating what are called direct financial obligations, basically how it's borrowing money. The FHLBNY, like other federal home loan banks, gets most of its money by selling debt securities. Think of debt securities like IOUs the bank sells to investors in exchange for cash. These IOUs are called consolidated obligations, and they come in two main forms: bonds and discount notes. These consolidated obligations are special because all 11 federal home loan banks are responsible for them, so if one bank has trouble paying, the others have to chip in. This is supposed to make these investments safer. But there's a catch: these obligations are only backed by the financial strength of the 11 federal home loan banks. The United States government does not guarantee them. That means if the banks run into serious trouble, investors could lose money. The report includes something called Schedule A, which lists all the bonds and discount notes the federal home loan banks are planning to issue, where the FHLBNY is responsible. It's like a schedule of all the borrowing the bank plans to do. Now here's where it gets a little tricky. This report doesn't tell you everything about the bank's debt. For example, it generally leaves out discount notes that mature in less than a year. Also, it does not show whether the bank is using the money it borrows to pay off old debts. To get the full picture, you need to look at the bank's regular reports. Another important thing to remember: the amounts listed on Schedule A are the face value of the debt. This might not be the same as the amount reported in the bank's financial statements because it doesn't account for things like discounts or premiums. So what does this mean? It means FHLBNY is actively borrowing money, and it's doing so through these consolidated obligations, which are shared across all the federal home loan banks. The document also lays out other considerations, such as that FHLBNY may use interest rate exchanges and other similar agreements to adjust how it handles its assets and liabilities. This is a way for the bank to manage risks related to interest rate changes, so that it can hedge risk and smooth out any issues that may come up with it having large obligations. Finally, the report is signed by an assistant treasurer of the FHLBNY, showing that the information is officially approved. Now, let's take a step back and look at the bigger picture. The federal home loan banks play a vital role in the housing market. They provide funding to member banks, which in turn lend money to people buying homes. So, when the FHLBNY borrows money, it's essentially helping to keep the housing market running. If the FHLBNY struggles to borrow money, it could lead to higher interest rates and make it harder for people to buy homes. The FHLBNY's debt levels can have an impact on the wider economy. So, is the FHLBNY in good shape? It is hard to say for sure from this report alone, but the fact that it is actively issuing debt suggests that it is confident in its ability to repay it. Of course, there are always risks. Changes in interest rates or the housing market could make it more difficult for the bank to meet its obligations. Overall, the FHLBNY seems to be navigating the current economic environment reasonably well, but the inherent complexity and interconnectedness with the broader financial system, particularly the housing market, introduces a degree of volatility. Thanks for watching. If you found this breakdown helpful, please hit that like button, leave a comment, and subscribe for more corporate decoding. We will see you in the next video.